Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's November 8th. I'm Frank Curzio. It's the Wall Street Unplugged podcast. So I bring the headlines and tell you what's really moving these markets. I'm so proud of my daughters. They go to two separate campuses for the school they go to, since one's in middle school and the other one's in high school. My youngest made the basketball team. My oldest made the soccer team. So really, really great stuff. Or is it? I mean, every parent wants their kid to play on sports teams, or at least be more active with programs, because it's going to result in you making lots of friends. It keeps them out of trouble somewhat. But if you're a young parent, you know, your kids are young, not really playing on these big sports teams yet, careful what you wish for. Because yesterday, this is just yesterday, okay? I dropped one of my daughters off at school. By the way, she's doing weightlifting as well, which I think is really, really cool. They just started weightlifting. And I dropped her off like 7:15. So it's a 25-minute ride, about 15 minutes with no traffic, but there's always traffic in the AM. Anyone can relate to that. Then it takes me an hour to get to my office, since I recently moved, you guys know, right? My daughter's made school a good school, so we moved out to Jacksonville. I haven't moved the office yet. I'm in the process of it. So I'm about an hour away, and I have to drive all the way here, which is, again, an hour. Now, both happen to have games, of course, on the same day. They're both away games, so there's two different schools. The first is at 4:30 p.m., the other's at 6. So normally, or sometimes, I might not be able to make their games. We try to make as many kids' games as we want, but it's their first game. My wife and I definitely want to be there. So my wife and I go to the first one. So drive an hour to her school, right? So it's 30 minutes for my wife. Takes a separate car since I went directly from work. Then it's about 30 minutes to get to my other daughter's game after that one ends. So my other daughter ends up finishing her game at around 7:30 p.m. I think it started around 6. So now we finish and we have to drive another 25 minutes home. And everyone, by the way, is starving. And my wife ain't cooking. There's no way she's cooking. They have to drive around the planet. Neither am I. I'm not throwing anything on the barbecue or whatever. I'm exhausted. So what do? We have to stop at Chipotle before we get home. And we get home around 9 p.m. Exhausting. But now they both have lots of homework. And they both happen to have tests the next day, which is today. So time to finish with homework, it's around 10:30 at night. And I want you to keep in mind the situation. I want to put in perspective here, right? For all of you who have kids or, know what I'm talking about. I have two daughters who are teenagers, right? They're teenagers. So they're pissed like 75% of the time unless they're on their phones or hanging with their friends, right? Not to mention they haven't taken showers yet, so they're still sweaty while I'm sitting next to them helping them with their homework. And that's cool. I was always sweaty. I played sports all the time, 24/7 growing up, most of my life. But now it's like 11 p.m. Going up to take showers, come back downstairs to dump their dirty school uniforms and all their sweaty clothes in the hamper, which my wife has to wash the next day. In the end, it's almost midnight before my wife and I get to sit down, watch a Netflix series, which is probably 30 minutes of one episode before both of us pass out on the couch because we're old now and over 50. We're really, really old. We feel old, driving the kids around like crazy. And then we run it back the next day, which is fun. So your best friend or someone who also has kids in school that you know, and they come up to you with a huge smile and say, guess what? You have no idea. My kid made the basketball team, the football team, the volleyball team. Don't say congratulations. Say, I'll see you in 5 months. It's much better. But seriously, I kind of love every minute of it. I mean, it's hectic. It's crazy. You're running around. You're balancing work. You're balancing family with everyone listening to this does, right? It's what life's about. Right? It's living your family. You're watching your daughters work hard, making lots of friends, kicking ass. Again, seeing them come home and do schoolwork and then go to school. It's great. It's really, really cool to see. And hectic, nuts. But I wouldn't change a thing. That's what it's all about. So let's get to the markets, which is keep going up every single day now, at least for the past 2 weeks. The S&P 500 is up 6%. It's over the past week, while the NASDAQ surged close to 7%. I think it's 9 days, someone told me, the longest win streak since 2021. 7%, guys. I mean, those are massive, massive, massive numbers for 1 week. You say, well, the market fell a lot before that. Yeah, but they were also up a lot before that, right? So some are saying, if you're reading, it's from short covering. A lot of people were short going in. Big money, again, being short heading into the year, maybe being on the wrong side, so now they have to cover their shorts and buy back stocks. Some are saying the rally is due to a huge decline in yields, which we had a huge decline, right? The 10-year hit 5%. And was it 3 weeks ago? Now it's 4.5%. Mortgage rates have come down. There's even an article saying mortgage rates came down. They're still like 3, 4, whatever they are. And mortgage demand ticks up. I mean, this is like, a week and a half. But that's a massive, just know if you don't follow bonds, that's a massive, massive move in yields in such a short period of time. And the high yields is like this fear factor. Wow, the Fed might have to raise rates even further. What's going on? And now they eased a little bit based on some of the data that's come out, which has been positive. And positive data means data that's really slow in the economy that's going to result in recession. That's now positive. That's good news for you. So if they say unemployment goes in 9%, yeah, that's awesome. That's great. That's great for the markets, right? But yet if it stays at historic lows, that's great for the markets. Everything is automatically great for the markets. Was it Singapore, whoever, what was it, where they just banned short selling and you see the markets go, anything they can, it starts going higher and higher. Remember, with the deficits that we have, the only way out of it is we'll never, ever stop spending, right? That's not on the table. We'll cover that in a minute. That's not on the table. It's by having this massive economic growth. And unfortunately, the Fed's doing everything it can to do the opposite, to slow growth. So now we're looking at a market that's trading 18 times forward earnings. That's higher than the 10-year average, a little bit higher. But you have to put in perspective. And even doing the math on this, because we always say, well, interest rates were a lot lower. If you look at a 10-year period, even taking 2022, where rates are 4 point whatever percent, right, to 5.3% now, over the past 10 years, looking at a Fed funds rate that was less than 1% over that time. And now we're 5.3. Not to mention the Fed was buying bonds, injecting trillions into the economy. Today, they're doing everything they can to force a recession. They're not going to say that to you. They're not allowed to. But the Fed's trying to put more people out of work, getting unemployment rate to 5% plus to control inflation, get inflation much, much lower, and no longer buying bonds to stimulate growth. And you know what? Before we go any further, I want to cover that because we hear that a lot. What does it actually mean? Fed not buying bonds, not accommodative. We hear these terms, and I feel like we just say them. Nobody really explains them. But let's look at the Fed's balance sheet. Because in 2022, the Fed's balance sheet hit a record. It was close to $9 trillion. And now I'm actually seeing stories that the Fed shrunk its balance sheet to $7.9 trillion. Yay, we should cheer. That's awesome. That's great, right? So shrinking it by a little bit more than $1 trillion over the past, I think it's around a little bit over a year, close to 18 months. Now, by shrinking, they're taking money out of the economy, out of the system. So credit becomes tighter and fewer dollars in the economy means less money being spent. That's the quick 101. A little bit more detailed than that. Just know that that's taking money out of the system. I want to put the balance sheet in perspective for you because sometimes you hear numbers and you could interpret them any way you want. But let's interpret them from the common sense point of view. Pre-COVID, January 2020, the Fed's balance sheet was at $4 trillion, which is insane at $4 trillion. Okay, because we're looking pre-credit crisis. Pre-credit crisis, right? Pre-COVID, January 2020, $4 trillion. Pre-credit crisis, January 2008, it was $1 trillion. $1 trillion. So it went from $1 trillion to $4 trillion. And what happened in that time period from $1 trillion to $4 trillion? Yeah, you had 2009 was there. Then 2010 things started getting better, and our balance sheet was around just over $2 trillion. So we spent $2 trillion. The Fed spent $2 trillion, which is crazy. Right? Because we had zero rates, we had all, the market was doing fine, yet they were like, hey, we're cool, this is all right, let's keep going. So they increased the balance sheet again, $1 trillion January 2008. By 1 year later, it was a little over $2 trillion. However, when you look at that money, where did it go? Went into bailouts, equity investments in banks, AIG, Fannie and Freddie. Yes, they got options, they got warrants, and they made a fortune. I always say it was the biggest mistake ever because they made so much money that if anything ever happened like this, they'd spend crazy. And now we saw what happened during COVID. But almost none of the Fed's balance sheet, almost none, came from buying mortgage-backed securities and treasuries, right? Bonds. So that's why when we push rates to zero from 2008 to 2016, rates were zero for that period. Think about it. That's a long time. Zero. We didn't see inflation go up. And everyone's like, how come we're not seeing inflation go up? That's nuts. That's crazy. because the money was given to companies. Money was given to banks, and the banks had the opportunity to lend it out or not based on however they felt. So even though money was basically free, and by free I mean anyone who wanted a loan would get it, right? We had low mortgage rates, a real estate boom. You had stock market on fire, every asset class surging. Very, very low cost to borrow. Everything did well, but it didn't spark inflation. Now let's talk about COVID and post-COVID. So the balance sheet, $4 trillion, this is in January 2020, $4 trillion. It went from $4 trillion to $9 trillion. Now the big difference here is not just that amount, which is freaking insane and off the charts and nuts, but almost the entire balance sheet outside of $500 billion of the $9 trillion was the Fed buying mortgage-backed securities and treasuries, just flooding the market with liquidity while also pushing rates back to zero again for most of 2020 and 2021. It's a reason why 2021 will go down as the greatest history, greatest market, greatest everything in U.S. history, probably for the next 10 decades. You'll never see conditions better than they were in 2021. No matter how much you try, no matter how much you sugarcoat it, it's probably the greatest conditions in businesses, for yourself, and the amount of money you're making in 2021 than any other time you've seen and any other time you're going to see, probably I would say in this 30 to 50 years. It's not a stretch. I mean, you're not going to see the government hand out trillions. You're not going to see it because of lockdowns. And again, what else did they do? They didn't even stop there. They didn't even stop there. Buying bonds, treasuries, mortgage-backed securities like crazy, pushing rates to zero. They handed checks to PPP loans directly to families and businesses here. They bypass the economy. Don't worry about it. Here it is. You have to pay it back? No, you don't have to pay it back. I always love that Harvard file for that. It's so great. That's awesome. But it's insane. Nobody questioned all this money since the first time we've ever locked down the entire country. We've never seen anything like that. And forget about COVID. I go on rants and all this stuff and why they want to keep it on lockdown as much as they can and different stuff. When we go there. But we've never experienced that. And everyone was happy because everyone was making tons of money. It was great. It was raining money. It was awesome. My surprise, I don't know. It's a big surprise, I think. I think economists are pretty smart. At least they're book smart. We know not common sense smart. Right? And I'm not putting down economists here, but I mean, the smartest economists in the world, including every genius working at the Fed, did not see inflation coming in 2021. Okay? And then when it came, they said it's transitory. Now, you all saw it. I saw it. Every person who pays bills in America saw it. Maybe they don't pay their bills. If they get their bills paid by somebody else, they don't have to worry about it. But every economist didn't see it. It's transitory. We're going to be fine. I mean, it's like having a crazy idea to defund the police and releasing convicted criminals from jail and thinking cities like San Francisco, New York would not become incredibly dangerous. Again, that's a hypothetical. That would never really happen, right? Because no crazy person or institution would ever think of defunding the police, right? Let's say if they're letting convicted criminals run through the streets. Nobody would ever do that. I'm just using it as a hypothetical, right? But here we have a very expensive market, one where growth is going to slow dramatically next year. I mean, we saw 5% GDP. Now we're going to see probably 2% and then into 1%, and people are predicting a recession. Again, this is exactly what the Fed is trying to do to slow growth. Again, they can't say they're forcing a recession, but that's what you need to do. There's no such thing as a soft landing. Trust me. So we have a very expensive market, one where growth is going to slow dramatically next year as the Fed shrinks its balance sheet, keeps rates higher for longer, which we know. One where 85% of the companies just reported this earnings quarter, and those companies raise sales estimates, which they always do. They forecast. They raise sales estimates by the slowest pace we've ever seen. I mean, this is since 2005, but that's as far back as the data goes when we're looking at companies where they really started reporting guidance all the time, and a lot of companies reported guidance. It's almost like formality now, like, hey, what's the guidance going to be for next quarter? What's the guidance going to be for next year, right? You want to, you pull that guidance, it's like a negative, right? Because then there's uncertainty in the stock and it'll go down. So everyone wants to provide some kind of guidance going forward. Well, all the companies, which is almost every one of them that reported by now, and this is data tracked by FactSet. So the raised sales estimates, it's at the slowest pace from these companies we've seen. And think about it, we're talking about COVID when things are crappy, the economy was closed. I mean, slowest. It's 2015. We also have a more where household debt just came out. This came out 2 days ago, and it's hard to even find. They have to do like certain searches, almost like they're burying it. I don't blame them. It came out like 2 days ago. It hits a new record. $17.2 trillion. So auto loans, student debt, credit card debt is all surging. It's going up, right? These numbers are supposed to be going down. They're still going up, along with delinquencies across the board for auto loans, student debt, credit card debt. Student debt is forecasting because, again, they didn't have to pay for 3 years and they just opened up and say, okay, we have to make them pay now. That's another thing. That's a massive amount of money. It's a $400 bill for tens of millions of Americans that they didn't have to pay for 3 years. That was suspended. $400, where 67 to 70% of Americans live paycheck to paycheck. You know how much that is? Not to mention the inflation rate is still close to double where it trades historically. People are sharing 3.7%. At 3.7%, we've said this before in past podcasts. Take out the last year and a half when we went to 9%. You have to go back to 1991, the last time it hit over 4%. It almost never does. We're at 3.7. We're cheering that. The Fed says they want to get it down to 2%. 3.7%, guys, is massive inflation if you take out the last 2 years. Again, it's going in the right direction. We're happy about it, but there's still ways to go. And what does that mean with that inflation rate, which is incredibly, incredibly, incredibly high, almost double the historical rate? It still means that, what, we're paying higher prices. You guys, are you paying higher prices on food? They're trying to tell you like a couple of items of food went down. Get at it. Electricity, you pay insurance. See real estate taxes lately, how much those went up? Your tuition, really? Your bills are going lower? Let me know because I'll live right next to you. Seriously, I'll sell the new house that I just built and go next to you. You tell me your bills are lower now than they were last month or 6 months ago or 1 year, 2 years ago. There's no way. They're going higher. And yet, despite these conditions, the S&P 500 is up 14% year to date, and the NASDAQ is now up 30% year to date. And we just rallied incredibly over the past 2 weeks. Again, biggest win streak in NASDAQ in 2 years. So what's my advice right now? Stocks are probably going higher to end the year. I know, it sounds crazy. It's going to be a really tough 2024. It really is. But short term, the next few weeks, all right, going into the end of the year, this is what's happening. This is why you should expect. It might not be the whole S&P 500. It might not be the NASDAQ. Most likely it's going to be the whole NASDAQ. Not the whole NASDAQ. Just, again, the S&P is represented by, I think it's the 10 largest tech stocks is 30% of that index now. Might even be a little bit more. The NASDAQ too, because they're heavily weighted in those tech stocks, and they're probably going to go higher. But not all stocks. Now, why am I saying this? Because there's tons of money managers. The ones managing trillions of dollars that are significantly underperforming the markets. And that happens often when you see strong gains in the major indices, especially when it's not broad. Right? I mean, if you're looking at the equal weight index for the S&P 500, it's trading below its 200-day moving average by a big amount. That means every single company in the S&P 500 has the same equal weighting. Instead of Apple being the largest based on market cap and the top 7 or 10 represent 30%, I think it's the top 7 actually. So you have a lot of these money managers, when you see this kind of outperformance where, hey, I could buy things that I don't need you and much, much less fees, right? You see these money managers underperforming their benchmark. And that's whatever their fund is, the benchmark is what they have to beat. Now, usually that benchmark, and someone's been in this industry for a long time, is some crazy random broad market index, right? It's never as simple as it's the S&P 500 or it's a NASDAQ. And by the way, no one would ever use a NASDAQ as their benchmark, ever, because they'd be getting annihilated unless you just own 6 stocks. You need a lot of exposure in those. So no one ever has a NASDAQ. No, they have these random, like, for example, first one I pulled, which is Vanguard. Vanguard manages trillions, right? So I looked at diversified equity fund, the first one I could find. Any one I found would be the same, which invests in both large cap, growth, and value, which means the S&P 500, right? It's basically every stock in the S&P 500. They use their benchmark, the MSCI Broad Market Index. Okay, I've heard of that. I've been in the industry. I bet most people haven't heard of it, but you don't really, oh man, did you see the MSCI Broad Market Index go up to? No, you don't say it. Did you see the NASDAQ? Did you see this? No one uses that. And that's all their benchmarks are some crazy, whatever. And there's a reason for that, because if you look at MSCI Broad Market Index, okay, it's broad, it's up 9.5% year to date, as opposed to over 14% for the S&P 500. And it doesn't matter if the market goes down 20%, it goes up 20%. As a money manager, you have to beat your benchmark. If not, you get fired, or there's no reason for you to own that fund. You can get a year of underperformance, maybe 2 years, fine, especially if you have a good track record for long term. But you better be beating your benchmark. That's your job. Or you're going to lose your job. And there's 80 people behind you that would take it in a heartbeat. Those guys that are shaking your hand, hey, how you doing? They'll take your job in a heartbeat. Okay, so that's your job. And right now, they're significantly underperforming the markets because they're up a lot, mostly due to a few stocks. Now, when you look at the MSCI, no coincidence that their specific fund, Diversified Equity Fund, is up around the same as the MSCI Broad Index, right? It's underperforming the S&P 500 by 5%, but which is okay. And it basically, you're buying the S&P 500, but this is a way, right, of you owning their fund, which is underperform the S&P 500 by 5%, while they're charging you 8x more on fees to be in their diversified equity fund, which, by the way, the fund's allocation, and I'm not joking here, it gets even better, their fund's allocation, when you look, when you see top 10 holdings, this specific fund happens to be in 6 other Vanguard funds. Full allocation. Like it's in the Vanguard U.S. Growth Fund, their Explorer Fund, their Windsor Fund. So this is a way to generate fees on top of fees for these guys, right? It's like getting the same dollar taxed 3 times while generating shit returns. And the company using the trillions of dollars of your money, the trillions of dollars collectively, that's basically they're effing you on to push and threaten the boards of companies to adopt crazy climate change and woke agendas that result in what? In these companies and corporations, their expenses going higher. Look at the auto companies being forced in EVs that they're getting annihilated on. Good example. So high expense for the companies, which results in reduced earnings, which result in lower stock prices, where again, you, the customer, the source of everything, gets fucked. Welcome to Wall Street. Where you not just take it up the you-know-what, but they won't even give you a towel to clean yourself. That's who you're competing with when you decide to go and buy stocks or short stocks. That's Wall Street. That's the real Wall Street. You're not going to hear that anyplace else. We're independent. We tell it how it is. I don't give a shit. And a lot of my friends are in these industries. I don't give a shit. We say it how it is. That's it. A fund with a BS benchmark that's charged you 8 times more fees than if you got into the S&P 500 fund, and that fund that you're buying is also that allocation of whatever it is, I don't know, hundreds of billions of dollars, is into 5 other of their ETFs, which are also making fees on top of fees. Crazy. And it's smart. Good for them, good for BlackRock. They know how to beat the system. They know how to charge you massive fees, but all this happens on your back. This is how they F you. They do it in SPACs every single time. This is what they do. They have to get you to buy in. This is your money, right? This is all people working at companies in the 401ks. This is all your money that they're using to gain power in while charging you a massive amount of fees, and they're not even doing their job. Now, getting back to the rally. Sorry about that mini rant. Getting back to the rally. Fund managers right now, they need to generate alpha. They got to outperform the markets. So you need to find a way to get their performance up since many are underperforming. And how do they do this? They buy names with the most strength, most momentum right now, or the ones that just reported solid earnings. Maybe some of these were down and now they reported solid earnings, and you saw, it's no surprise these names would be up 5 to 7% after the report, which they report earnings when the market's closed. So they do it pre-market or after market. But when the stock market opens for trading, these stocks all of a sudden immediately ramp 10, 15, even 20% higher. Right out of the gate. End at the highs of the day. That's what happens. Those are the names. You want to get into the momentum names. This way you're generating alpha. You're trying to beat and get that performance up. And you need to because it's your job. Kind of like a politician. They don't care about you. They care about keeping their job. Everything they can to keep their job. It's also other names that have underperformed this year, which is the Russell 2000, many small caps, are going to do the opposite. They're going to be sold down even further for tax loss purposes. So in other words, we're going to have this forced buying and selling of names. And it's almost artificial. I mean, it's really happening, but they're not long-term in nature. These stocks aren't going to be long-term in nature. They're not going to be so long-term in nature. It's going to be for reasons for the next 4 or 5 weeks or so. It's just positioning, and this is why everyone says seasonally, this was a good time to buy. It's why a lot of these folks say, and a lot of sentiment indicators, when they're that negative going into November, It's easy to say, hey, usually we see a market rally right now, regardless of conditions, regardless how much we have much more debt, regardless how interest rates are. It's just the way they have to position themselves. But this year, it's much more meaningful with the major indices up so much, so many fund managers playing catch up, especially the ones that didn't have those big investments in the top 7 tech stocks, which drove most of the gains for the NASDAQ and the S&P. So tomorrow, Daniel and I are going to break down at least 50 of these names that should go much higher over the next month as we approach year end. These are the names that the fund managers are buying. We're also going to highlight names that could see further downside as investors look to match the losses against the capital gains they made this year. That's why they pay less taxes, right? There's less capital gain tax. Now, keep in mind, in the Russell, those names sold off sharply. Okay, we're probably looking at a lot of small cap names, which the last time they underperformed large caps by this much, I think I want to say 26, 27 years ago. That's how long ago. So a lot of these names you're seeing saying, wow, a lot of these things could be buys right now. You might see them push a little bit lower just for tax loss selling, again, forced selling. Those names tend to pop 100, 200, 300%, and you might think that's crazy, but when you go from 10 to 2, I mean, that's a massive decline. And you'll see some stocks like that. And you're like, why are they going down? Things are better. They ride the ship. They were preparing for this recession for 18 months. Why does it keep going down? Simply because you need those losses to offset the gains. But yet, if you see it go to 4 to 6 to 7, you're looking at 200% plus gains. And you're still trading 30% below your 2-year high or 52-week high or whatever. So you have all this forced selling into this year that almost reverses and turns into massive buying, and you usually see the insiders, especially because they're like, wait, this is a joke. And the insiders, who are the large owners of these stocks, know everything about, are going in there and purchasing, which I'm starting to see for some names. It's why I'm so bullish on small caps. You've never seen this type of outperformance or underperformance against large caps. I'm not telling you to buy the Russell 2000. Okay, even if we go into a recession next year, small caps tend to suffer more, but these are names that are down 60, 70% already. It's one of the greatest opportunities to pick up small cap names in a very, very long time, guys. Trust me, it's a sector I specialize in for most of my 30-year career. I just load up on one name. I put $200,000 into it. You guys probably know what we sent out. Hey, this is what we're doing. If you want to get to Curzio Venture Opportunities, you can. Because the sell-off was already way overdone. And yes, it's a name that underperformed this year, but it got to levels where it was stupid. And they have massive catalysts coming up. And for me, I'm going to be an aggressive buyer of small caps in the weeks and months ahead, just when I'm seeing this, when I'm seeing these massive, massive disconnects. You don't have opportunities like this often, where just everyone's just throwing these names away and saying, and they're already down a lot, but you're likely to get even better pricing. You probably get it now. Maybe you see a little volatility towards the year end. But man, next year, you're going to see small caps really rocket higher. Even if we do go into a recession, at least some names are going to stay down so much. But Daniel and I are going to break down all this tomorrow's Wall Street Unplugged premium podcasts. To learn more about that podcast, go to CurzioResearch.com. The quick take is it's $10 a month. And you get literally dozens and dozens of trading ideas, detailed analysis, like we do here, provide lots of education and how we're recommending this stocks and why we like it. But $10 a month, probably thousands of dollars less than the fees your funds are charging you to underperform some crazy benchmark that you never heard of. That's what Wall Street Unplugged Premium is all about. And Daniel and I are going to break down lots and lots of ideas tomorrow. So guys, that's it for me. Hope you enjoyed the podcast, and I'll see you tomorrow. Take care.